What's the challenge here on the income line, Andy? Because income was obviously down 5%. Interest rates not helping with this story at the moment. But are you surprised that you're not seeing a bigger pickup in activity given the rebound that we're enjoying?
We've really got two things going on and in very different directions. So interest rates reducing significantly over the last year has clearly taken a lot out of what would otherwise have been our published income. However, what we have seen is considerable growth in customer demand and appetite and requests for loans. So our loans to customers are up 6% already 6 months into the current year, and our trade activity is at the highest levels we've had since 2018. So the underlying is very strong. It's just we're going through a 12-month period when, on an annualised basis, we've got the interest rate effect normalising.
Yeah, I mean, the challenge for everybody, I guess, is to make sure that those loans are profitable. Do you think we may be at the bottom here on NIMs?
I hope we are at or very, very close to the bottom on NIMs. It's clearly been a very big correction that has occurred, and most of the major rates now seem to be settled. So I hope you're right. I hope over a period of time we can maybe see those pick up, not necessarily very near term, but certainly over the next 2 or 3 years, we'd expect to see a little bit of pick up there from historically very low rates at the moment.
As we look at the bond market recently, the signals that it appears to be sending is that it expects very low growth and persistently low rates going forward, somewhat at odds with the growth numbers and the messages coming from the equity market. How do you square it?
I think it depends which part of the world one is looking at. Certain parts of the world are more buoyant at the moment and other parts may be a bit less so. We're fortunate a lot of our activity is in Asia, where overall the growth rates, I think, are the strongest and are coming through the whole COVID sort of period. So I think we'll see the rest of the world over a period of time catching up to those levels. But as we all know, the effects of COVID are still quite patchy and they're going to be with us for some period of time coming forwards.
Andy, obviously, big repayment to shareholders here, announcement on the interim dividend and the share buyback at this stage. What does that mean in terms of the programme for increasing dividends and paybacks for the rest of the year?
So we've been very clear that to the extent we have excess capital, we will be very happy to return that to shareholders if there are not profitable opportunities to invest that money. We said today that we will do another $250 million buyback. We actually did a $250 million buyback earlier this year, so it's the second time this year. This time last year, we were not paying interim dividends. We have now recommenced the interim dividends. So as the profitability of the business picks up, we will be returning more to shareholders.
Just on Hong Kong and the state of the economy there at the moment, what's your best read on the resilience of the Hong Kong economy and its prospects over the next 6 to 12 months?
I think the evidence is that Hong Kong tends to be more resilient than people give it credit for. If you go back over a number of years and look at a number of big events, people have been from time to time very concerned about the economy. But the facts are it tends to pull through, it tends to rebound. And certainly if you look at our own performance over the last 24 months, we have performed very strongly. Our income levels are now back to the levels that they were at previous to COVID, and there is a good momentum there. So I think there is a natural heart to the economy there that is robust, it is resilient, and for us having a strong franchise there is a huge benefit to the group overall.
And just a line on costs, Andy. I think last time we spoke to you, we talked about reductions in the branch network. This time round, costs up 8%. The line is mainly for higher compensation for bankers. Can you tell us a little bit more about cost management at the moment and your intentions?
Yeah, the costs are up, but that is entirely what we had thought would be the case. There's really two reasons. One, last year, the compensation accruals were low because profits were low and the overall market clearly depressed. Obviously, this year we are hoping to return back to more normal levels of return, and therefore we'll see a normalization. And secondly, just the foreign exchange translation into US dollars. Those two together explain nearly all of the 8%. So we are very much on track. What we are doing on the cost front is increasingly focusing on investment in new digital technologies, digital businesses, digital platforms, and hence the proportion of our investment that is going there is ever increasing.